Hello friends, Victor here. In this video, I want to talk about whether we're in an AI bubble and what I plan to do if the market heads into a correction in the coming months. I'm making this video because there's been a lot of speculation and fear, especially from mainstream media and many investors claiming that the market is in an AI bubble or that a correction is coming. Many investors, especially the doomers who are very bearish on AI, believe that the current AI boom is very similar to the dot-com bubble of the late 1990s and early 2000s. Just to give you an example, Michael Burry recently made two massive bearish bets against Palantir and Nvidia. Michael Burry is arguably the most well-known short seller, or what many would call a contrarian investor. He became famous for predicting the 2008 financial crisis. Back then, he shorted the US housing market and subprime mortgage, generating over $700 million in profits for his investors and approximately $100 million for himself. It was called the Big Short. Naturally, whenever he shares his thoughts or his investment thesis on social media, many investors and news media pay very close attention to him or even follow his trades. For example, he posted this on Twitter recently that went viral. Then according to his latest 13F filing, it was revealed that he bought two massive put positions to bet against Palantir and Nvidia. These two puts currently make up about 80% of his reported portfolio. Also, right before I started making this video, SoftBank announced that it sold its entire stake in Nvidia. The reason is that SoftBank has committed over $30 billion to invest in OpenAI and needed the money to fund the Stargate project with other partners in the US. Of course, many investors, especially the doomers, took this the wrong way. They believe that we're in an air bubble or that the market is heading toward a correction in the coming months. As retail investors, I think it's important that we should always think for ourselves, invest in what we understand the most, and not blindly follow the famous investors' latest trades. So in this video, I'm going to talk about whether we're in an AI bubble, why I believe Michael Burry is wrong again, why AI demand is real, and what I'm planning to do if the market heads into a correction in the coming months. If you enjoyed this video, make sure to hit the like button, subscribe, and turn on notifications. I will continue making high-quality investing videos a week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you'd like to support the channel, check out my Patreon in the video description below. Our goal is to help all our members become multi-millionaires through intelligent investing. As a premium member, you'll be able to follow all my latest stock trades and portfolio rebalancing. You'll get access to my intrinsic valuation models for the stocks I'm analyzing, so you'll know when a stock becomes undervalued, fairly valued, or overvalued. On top of that, you will receive my latest stock ratings, exclusive premium content, and access to our Patreon-only Intelligent Investor Discord community. All the links to my Patreon and my X account are in the video description. Make sure to check them out. For many investors, this is the most important question right now. Are we in an AI bubble? Contrary to what many investors and media outlets believe, I'm going to explain why we're not in an AI bubble at all. First of all, it makes no sense to listen to the perma-bears, the naysayers, the short sellers, or the headlines constantly telling us about an AI bubble. Most of these people have been sitting on the sidelines and missing out on this bull market. More importantly, many of them don't understand AI at all, how AI is transforming many industries, why it's mission critical to win the AI arms race against China, and why it's necessary to build gigawatts of AI data centers to meet surging AI demand. Second, many investors and mainstream media have been pushing a false narrative about an AI bubble, mainly because they want to grab more attention and, of course, drive much higher advertising revenue. Third, today's AI boom is nothing like the dot-com bubble. I will explain more later in this video. Fourth, unlike what the perma-bears claim, AI demand is real. AI is not a fad. Hyperscalers are already generating billions in AI cloud revenue by renting out their compute capacity to customers. And fifth, hyperscalers will continue building gigawatts of AI data centers, not because of hype, but because they need the capacity to fulfill massive cloud-remaining performance applications, or RPOs, and to meet ever-growing customer demand. In my view, it's best not to follow Michael Burry's trades, even though he famously predicted the 2008 financial crisis. If you look at his past social media posts and calls, you will notice that his track record since then has been wrong most of the time. In fact, he has been predicting a market crash or a bubble almost every year. His timing has been wrong most of the time. So if you had followed Michael Burry's trades or his bearish predictions, you have missed out on most of the major bull markets over the past 10 years, including the current bull market that started in early 2023. Here's another example that shows why it's important not to follow Michael Burry's trades or his investment thesis blindly. In one of his recent posts, Burry claimed that the hyperscalers have been artificially boosting their earnings by extending the useful life of server equipment beyond 3 years and understating server equipment's depreciation expenses. But here's the important part you should know. I posted this on Twitter to counter Burry's investment thesis. Michael Burry is focusing solely on balance sheets and accounting rules for amortizing server equipment without understanding the much bigger picture. AI demand still far exceeds compute supply. Hyperscalers have to invest heavily upfront to meet customer demand and fulfill their massive cloud-remaining performance applications, or RPOs. AI GPUs tend to last much longer than 5 years. For example, older GPUs such as Nvidia's A100 and H100 AI GPUs are often reused for AI inferencing workloads, while the newest AI systems like the Blackwell GB200 and GB300 AI systems are often used for the most compute-intensive AI training workloads. Nvidia's 5-year-old A100 AI GPU is still used for many AI inferencing workloads today. And according to Google, its 7- and 8-year-old TPUs are still running at nearly 100% utilization because of the massive cloud computing demand. In other words, the useful life of AI GPUs and custom ASIC accelerators often lasts more than 5 years because we're in a compute-constrained environment where demand for more processing power still far exceeds supply. Let's talk about the major differences between the current AI boom and the dot-com bubble. Most investors and mainstream media who are bearish on AI do not understand these differences at all. First, today's AI boom and massive AI spending are being driven by the world's largest and most profitable tech companies, including Microsoft, Google, Nvidia, Amazon, Meta, and Oracle. These tech companies generate the most profits and most free cash flow compared to the rest of the S&P 500 companies. More importantly, these mega cap tech companies are funding most of their AI data center builds using their own earnings and cash flow. Only recently have they started to use debt and external financing to support their AI infrastructure investments. Just to compare, during the dot-com bubble, most internet startups had little to no revenue and no sustainable business models. They rely heavily on venture capital funds, IPO proceeds, and debt to stay afloat. So when the bubble burst, funding dried up, and most of those internet startups with no real income went bankrupt. Second, the current AI boom is driven by real and growing AI demand. Hyperscalers are building gigawatts of AI data centers to support increasing AI usage from consumers, large enterprises, and governments around the world. AI adoption is happening much faster than any previous technologies. That's because this AI boom is built on top of more than 20 years of internet infrastructure, a mature cloud computing ecosystem, and billions of computers and smartphones around the world. On the other hand, during the dot-com era, most internet startups were simply overhyping their businesses. They assumed that customers would instantly come once they launched their websites. But in reality, internet adoption was much slower than expected because the internet was new and consumers took much longer to start using many internet services. Now, many bears believe that the current infrastructure build is similar to the fiber optic build during the dot-com bubble. That's completely wrong, and here's why. During the dot-com bubble, telecom companies and startups spent hundreds of billions of dollars laying out fiber optic networks across the US and around the world because they believed that internet demand would grow exponentially as soon as those networks were built. Their business model was simple: build first and customers will follow. Of course, that did not happen right away. Internet adoption and traffic did not explode right away. It actually took many years for the internet to mature. As a result, more than 90% of fiber networks went dark and remained underutilized for many years. During that time, most telecom companies and startups eventually went bankrupt because they rely heavily on debt, IPO proceeds, and VC funds to fund their projects. And there simply was not enough demand to support their fiber networks. On the other hand, the current infrastructure build is completely different. AI demand is already here, but the entire market remains compute constrained. Even after 2 years of massive AI data center builds, there still is not enough computing capacity to meet AI demand. Most hyperscalers do not have enough compute to fulfill their cloud backlogs and customer contracts, so they're forced to invest billions of dollars or more to build gigawatt-scale AI data centers. Right now, almost all AI GPUs and custom AI accelerators are running near 100% utilization, even including the last-gen AI chips from Nvidia and Google. Whenever new compute capacity comes online, hyperscalers can often earn cloud revenue almost right away because major customers like OpenAI, Anthropic, and many other AI companies have been waiting for more compute capacity to come online for many months already. Power will continue to be the biggest constraint in the coming years. So even if the hyperscalers wanted to overbuild AI infrastructure, they simply cannot because there is not enough power that can come online quickly, especially in the US. I believe this huge power limitation will likely prevent the hyperscalers from overbuilding AI data centers in the US. The key difference is this: during the dot-com bubble, there was too much optic fiber supply and not enough demand. Today, in the AI era, it's the exact opposite. AI demand is massive, but there's not enough compute capacity and power to meet it. Another huge concern for investors is that US stock market as a whole still appears overvalued compared to historical levels. For example, at the time of making this video, the FINRA margin debt ratio relative to the US dollars in circulation is quite high, sitting above 0.4. This usually suggests that the overall market is still overvalued and overbought. Moreover, the Shiller P/E ratio is currently around 40, which is quite high compared to its average over the past 20 years. However, both the FINRA margin debt ratio and the Shiller P/E ratio are still well below the levels we saw during the dot-com bubble in the late 1990s and early 2000s. If you want to know whether the current market is likely near the peak, one great way is to look at the number of IPOs compared to the past bubbles. Typically, when the market is near the peak, or when there's a major bubble, you'll see a huge surge in companies going public through IPOs and SPACs. Right now, I don't believe we're at that stage yet. This is because the number of companies going public this year is still far below the levels we saw during the SPAC boom in 2021 and the dot-com bubble in 1999 and early 2000. My best estimate is that this current bull market should continue for another 2 years because of the massive AI infrastructure build-outs and the growing demand for frontier AI models and AI applications. Now let's talk about AI demand and why it's real. First, let me show you a recent interview with OpenAI's Sam Altman from a few weeks ago.
But let's shift gears a little bit. Obviously, OpenAI is one of the fastest growing companies in history. Satya, you said on the pod a year ago, this pod, that every new phase shift creates a new Google. And the Google of this phase shift is already known, and it's OpenAI. And none of this would have been possible had you guys not made these huge bets. With all that said, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, big commitments, 500 million to Nvidia, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly. We do plan for revenue to grow steeply. Revenue is growing steeply. We are taking a forward bet that it's going to continue to grow, and that not only will ChatGPT keep growing, but we will be able to become one of the important AI clouds, that our consumer device business will be a significant and important thing, that AI that can automate science will create huge value. There are not many times that I want to be a public company, but one of the rare times it's appealing is when those people are writing these ridiculous OpenAI is about to go out of business and whatever. I would love to tell them they could just short the stock, and I would love to see them get burned on that. We carefully plan. We understand where the technology, where the capability is going to go, and how the products we can build around that and the revenue we can generate. We might screw it up. This is the bet that we're making, and we're taking a risk along with that. A certain risk is if we don't have the compute, we will not be able to generate the revenue or make the models at this kind of scale.
Exactly.
And let me just say one thing, Brad, as both a partner and an investor. There is not been a single business plan that I've seen from OpenAI that they're put in and not beaten it. So in some sense, this is the one place where, in terms of their growth and just even the business, it's been unbelievable execution, quite frankly. I mean, obviously, OpenAI, everyone talks about all the success in the usage and what have you. But even, I'd say all up, the business execution has been just pretty unbelievable.
Interestingly, Sam Altman posted this on Twitter recently after his interview with Brad. In that post, he explained how OpenAI plans to fund 1.4 trillion in infrastructure spending over the next 8 years. These are the key takeaways. OpenAI is planning to become an AI cloud provider. This means that even if OpenAI builds more AI data centers than it needs, it can still generate revenue by selling excess compute capacity to other customers. To finance this massive infrastructure build-out over the next 8 years, OpenAI will raise additional capital from investors and expects its annual recurring revenue, or ARR, to grow from 20 billion in 2025 to hundreds of billions by 2030. First, how is OpenAI going to pay for all this infrastructure it signed up for? We expect to end this year above 20 billion in annualized revenue run rate and grow to hundreds of billions by 2030. We are looking at commitments of about 1.4 trillion over the next 8 years. Obviously, this requires continued revenue growth, and each doubling is a lot of work, but we're feeling good about our prospects there. We are quite excited about our upcoming enterprise offering, for example, and there are categories like new consumer devices and robotics that we also expect to be very significant. But there are also new categories we have a hard time putting specifics on, like AI, that can do scientific discovery, which we will touch on later. We are also looking at ways to do more directly, sell compute capacity to other companies and people. We're pretty sure the world is going to need a lot of AI cloud, and we're excited to offer this. We may also raise more equity or debt capital in the future, but everything we currently see suggests that the world is going to need a great deal more computing power than what we are already planning. According to the Wall Street Journal, OpenAI projects that its annual revenue should reach as high as 200 billion per year, and that it should achieve positive free cash flow by 2030. However, between now and 2030, OpenAI expects to lose billions of dollars each year because of its massive AI infrastructure investments and high R&D costs. Interestingly, one of OpenAI's biggest competitors, Anthropic, expects to become profitable and cash flow positive much faster by 2028. Anthropic has a much leaner business model and doesn't have the same massive AI infrastructure commitments as OpenAI. That's why Anthropic will likely achieve profitability much faster than OpenAI. Now, I want to show you another clip that shows current AI demand is real and that it's much larger than anyone expected. In this clip, Armin van Dat from Google explained that Google has been building TPUs for 10 years. More importantly, he mentioned that even Google's 7 or 8-year-old TPUs are still running at 100% utilization because AI workload demand is so high and there simply isn't enough compute to meet all the demand.
We're early in the cycle is what I would say, certainly relative to the demand that we're seeing. So our internal users are, we've been building TPUs for 10 years, so we have now 7 generations in production for internal and external use. Our 7 and 8-year-old TPUs have 100% utilization. Right. And that just shows what the demand is. Everyone would, of course, prefer to be on the latest generation, but whatever they can get. So this tells me that the demand is tremendous, but also who we're turning away and the use cases that we're turning away. It's not like, oh yeah, that's kind of cool. It's, oh my gosh, we're actually not going to invest in this, and there's no option because that's where we are on the list. Same with many of you in the room. Right? We're working with many of you in the room, and many of you are telling me directly, and thank you, we need more earlier. Now, the challenge here, though, is, as you said, that we're limited by power. We're limited by transforming land. We're limited by permitting, and we're limited by backup delivery of lots of things in the supply chain. So one worry I have is that the supply isn't actually going to catch up to the demand as quickly as we'd all like. I heard in the previous session some of the discussions of the trillions of dollars that we're going to be spending, which I think is accurate. I'm not sure that we're going to be able to cash all those checks. Like, in other words, literally, you all have some money, you can't spend it all as fast as you want. I think that's going to extend for 3, 4, 5 years.
Let me show you more market indicators here. According to a forecast from Citi Research, global AI-related capex is expected to grow from $415 billion in 2025 to over $2 trillion by 2030, because all the major hyperscalers will need to increase their investments in AI infrastructure to meet customer demand and support their own internal workloads. This projected growth represents an estimated compound annual growth rate CAGR of about 45% from 2025 to 2030. Meanwhile, AI service revenue is expected to grow even faster at a CAGR of 86% over the same period. So among the leading AI players, Google Gemini and OpenAI ChatGPT are expected to generate the most AI revenue over the next 5 years, followed by Anthropic Cloud, Microsoft's AI services, Grok, DeepSeek, and other AI companies. Here's another indicator that shows AI demand still far exceeds the available compute and power capacity. According to the most recent earnings reports, all the major hyperscalers, including Oracle, Microsoft, Amazon Web Services, and Google Cloud, have reported record high cloud backlogs driven by both AI and non-AI workloads. For example, Oracle now has over $455 billion in cloud RPO backlog that it needs to fulfill over the next 5 years. With this massive backlog, Oracle estimates its cloud revenue should grow from $10 billion in fiscal 2025 to as much as $166 billion by fiscal 2030. Microsoft recently reported that its commercial RPO increased to $392 billion, and this doesn't even include the additional $250 billion Azure commitment from OpenAI that was announced on October 28, 2025. If we combine these numbers, Microsoft's total RPO backlog would be roughly $642 billion. Similarly, Google also reported record growth stating that its cloud backlog increased 46% sequentially and 82% year-over-year, reaching $155 billion at the end of Q3. Management said that this increase was driven primarily by strong enterprise AI demand and that the company has signed more billion-dollar deals in the first 9 months of 2025 than in the previous 2 years combined. Amazon's management also said the same thing in the recent earnings call. AWS is now growing at its fastest pace since 2022, reaccelerating to 20.2% year-over-year growth, which is its largest growth rate in 11 quarters. More importantly, management noted that their cloud backlog had grown to $200 billion by Q3, and that number doesn't include several unannounced deals in October, which together exceed the total deal volume of the entire third quarter. CoreWeave, one of the major new cloud providers, also commented on the massive AI demand and ongoing compute constraints. Management explained that customers are still renting older H100 GPUs, even 3 years after launch, at prices within 5% of the original agreement. This shows that the useful life of Nvidia's AI GPUs is much longer than 3 years. So what's my plan or my investing strategy going forward? I see two possible scenarios, a worst case scenario and a best case scenario. Right now, there's a lot of noise in the market. Many bears and media outlets keep spreading misinformation, claiming that we're in an AI bubble. I think it's important to ignore all this market noise and stay focused on business fundamentals instead. If the market goes into a correction in the coming months, my plan is very simple. Stay invested, do nothing, and wait for the market to recover. If I have extra capital, I will continue to buy the dip, but I will only invest in high-quality companies that I understand the most. The market always recovers after several months or several quarters, and eventually reach new highs in the long run. Now, under the best case scenario, the bull market should continue for another 2 years or more because of the massive AI infrastructure builds and the strong demand for frontier AI models and AI applications. Either way, my approach remains the same. Ignore all the market noise and focus on investing in the best businesses. If stocks remain overvalued, I will just hold rather than buy more stocks. Personally, I prefer investing in high-quality companies only when they're likely fairly valued or undervalued. I also think it's important to avoid FOMO and stay away from speculative stocks that may have huge potential returns but with a lot of risk. For example, let me show you one of my investment accounts. I also have other accounts that have nearly the same stocks as this account. Right now, my investing strategy is to keep adding to my core holdings such as TSMC, Google, Nvidia, AMD, Broadcom, Amazon, Apple, Microsoft, Meta, and Netflix, and hold them for the long term. These companies are the market leaders in their industries. They have excellent management teams, strong long-term growth prospects, the best products and services, and durable competitive advantage. They also generate the most profits and most free cash flow. So even during market corrections, they are much more resilient than the smaller companies with much weaker fundamentals and with little or no moats. I like to invest in these outstanding businesses only when they're likely undervalued because that will greatly reduce the downside risk. I did make a minor mistake in this account. When Oracle was near its peak about a month ago, I was fear of missing out. So I started buying Oracle shares. To correct this mistake, I've been dollar cost averaging and adding more Oracle shares in recent weeks because I believe the stock is undervalued now. That said, I'm limiting my Oracle weighting to around 2% to maximum 3% in case I'm wrong about Oracle. Still, I expect Oracle should eventually recover in the coming months because of its massive $455 billion RPO backlog. Oracle will convert this huge RPO backlog into revenue and profits as the company deploys more compute capacity for OpenAI and other cloud customers in the coming months. Now, everything I've shared here is just my opinion based on my own research and analysis. This content is for informational and educational purposes only. It is not financial advice. There are always risks in investing. So it's important to invest in what you know and not speculate. Always do your own research and thorough due diligence first before making any investment decisions. Thank you for watching and supporting our channel. This is Victor from the International Investor channel, and I will see you in the next video.